Hello and welcome back to the TF Team podcast series. This is Between Dollars and Dreams. I'm your co-host David, and today I'm joined with Kevin from APS Mortgage Team. He's here to advise us from the mortgage broker side of things. And Kevin, why don't you introduce yourself and sort of tell us what you do?
Hi, David. Thanks for having me on the show again today. It's been a little bit a while, but I'm happy to be back. And I'm a mortgage broker, part of APS Mortgages. I'm proud to be part of this team. We're a very high-performing group, and we have a very great synergy and relationship between a lot of different lenders. Some of them, everyone's familiar with, the big banks, and some not as familiar with, but they do have great products for the different needs of our clients. And I've been in this business for about 3 years now. And like I said, I'm very proud to be part of my team because we're doing great things right now, and our clients are very happy. That's for sure.
Excellent. Well, thank you so much for joining us today. I know you just mentioned you've been there for about 3 years. Over those 3 years, you must have seen a lot of changes, but perhaps now more than ever. I'm not sure. But let's sort of address a few different questions that a first home buyer here in Ontario probably has for somebody with your experience. So I guess let's start the essentials. Like if I get pre-approved, what does that really mean? Am I ready to buy at that time?
Well, essentially, if you have a pre-approval from a mortgage broker or any lender, essentially it means that you're ready to shop, right? We've looked at your income. We understand your credit situation and your debts, and the lender is willing to give you an amount that you're willing to, you're able to go buy with. And it's important to get a pre-approval early in the process. You don't want to be walking and looking at different units if you don't have this pre-approval, because you might not be able to put in an offer and get and acquire this property, right? So I always recommend, before even speaking to your realtor, having that pre-approval, at least an amount in mind. So when you do these walkthroughs and you see the property that you like, you ask your realtor to make and put the offer in for you.
Okay, fantastic. That's great advice. So I guess the next question, follow-up to that would be, how much do I realistically need to save before I'm looking into buying?
Well, that's a very good question because it depends on the price of the property, right? In the GTA, Toronto area, let's assume that houses on average are $1 million. It's fair to say that you might need to have 20% down, right?
Okay.
Which
so
is
we're looking at $200,000.
Let's just say it's $200,000.
Yeah.
But we could put less down depending on if we can qualify for it. So there's insured mortgages for less than 20% down, but the thing about this is that it's not 100% guaranteed. You need to qualify for it, so your income needs to be very strong. But we always forget about the other side, which is the debts that we've accumulated over time, which is from lines of credits, from car loans. These things impact our ability to borrow more. So if you're going to put less than 20% down, you got to know there's no negotiation and there's no wiggle room and no exceptions that could be made. And we'll be talking about the GDS and TDS ratios after, but essentially I'll give you guys a preview. That 39-44, it may not mean much right now in this context, but that number, it cannot be higher than those two ratios. The lenders will not deviate and they will not actually make any concessions being out of that range.
Okay.
So it's a hard question to answer because we're talking about the GTA Toronto area context. But if you're looking at buying somewhere a little bit further away where the housing prices are a little bit lower, that's something that you may be able to qualify for. I had a client last spring. He bought his first home and he lives in Sarnia. So he put down 12.5%, which is, it's still sizable for around a $400,000 home, but it's not quite the same as 20% down for $1 million home.
Absolutely.
Yeah.
So again, we know obviously the GTA is a very hot market, shall we say. The prices are going to be a little bit higher. If we go outside, we probably have a little bit more option as far as pricing. But depending on how much of a down payment we have, that sort of gives us the wiggle room for negotiation. And what you're saying is if we have less than that 20% down payment, our wiggle room is really limited. But if you have more, you might have a bit more, a few more options in that regard.
It's also true. What you're saying is very correct. If you have more money towards your down payment, you're borrowing less essentially, right? But your income is also important, a part of this equation. You need to have an income, and obviously we have to look at each person's situation and file separately because it's not a one size fits all. But what about the debts, right? People tend to forget these things. Income is really important, and we talked about debts as also being the other kind of the balancer or the equalizer. If you have too much debt and you have high income, it doesn't really help that much either. So if you're going to put down way more money towards your down payment, it does help significantly. But here's the other side of the coin. You have to have more money. And that also is a challenge for a lot of first-time home buyers, right? Mm-hmm. So there's no perfect balancing act. And we'll address these things and talk about strategies and, things I've seen over the time I've been doing, doing this. There's a lot of different things that we can do. And also, depending on if you're going to rent out your unit as well, that changes situation, right? So a lot of nuance and not something we could discuss over, a couple sentences.
Absolutely. But we do have that upcoming webinar coming up on March 31st. So if you can join us, I know you'll be part of that webinar. So if you can join us on Tuesday, that's from 6:30 to 7:30 p.m. Eastern. We'd love to see you then and hope you can participate. So we've talked a bit about debt and we've talked a bit about the mortgage and how much of a down payment we need. But let's talk about credit score. What kind of credit score do you typically need?
So this also really depends. So if we're going to go with like an A lender, which is your big six bank that we're used to, I don't want to name drop them. We all know Scotiabank, TD, BMO as being some of the examples. We typically want to see something like 680 and higher, right? But there are options for people that have credit scores a little bit lower. And we go with these B lenders, which B doesn't stand for bad in any way, but they help, business owners, people that are self-employed, people that are not your typical T4 income earners. There's other options and more, flexible or common sense lending products for them. So if you may have a lower credit score, there is still an option for you. Interest rate is a little bit higher. And also there may be like some fees involved, but getting yourself into your dream home is also like, it's a big deal as well. So sometimes the trade-offs may make sense, but we always have to look at it from a mathematical point of view. Does it actually mathematically make sense? Can you qualify? Does it stretch you too far? Does it make your finances a little bit difficult month to month? These are things that we need to talk about as well, right?
Absolutely. And having a strong financial plan is obviously something that we recommend at all times. And of course, that always brings back the emergency fund as well. So we talked a bit about interest rates here. So what happens if I buy and the rates fall?
So actually, there's two parts to this, right? So if we could talk about the time in which you are putting in the offer as well as, before closing. So what we normally do is we have something called like a rate discretion. So we can, if the rates increase, it's not a big deal because we'll just keep the rate the same. But if it keeps falling, we could apply for what's called a rate discretion. And then at closing or close to closing, we could lock in the rates, like the lower rate at that stage.
Okay.
If it's after closing, for example, well, it depends if you have a fixed or a variable mortgage, right? So if it's variable, as the rates decrease, your rates will also decrease. But if it's fixed, to simply put it, you've already locked it in at whatever rate it was at, right? Mm-hmm. So you don't get the benefit of lower interest rates as the rates decrease. So to kind of like summarize all of this, it just, there's a side to it. Like we could, I know everyone's always worried about the rate. The rate's very important. It is important, but it's not everything. That's a conversation for another day. But if we worry about the rate, being lower before our closing, that's not something 100% we need to be worried about, because with a good mortgage broker, with dialogue, we could be able to kind of facilitate that and making sure that you get the lowest possible rate before the close. Okay. So that's important. And then the second portion of it is just fixed and variable. Hey, I know hindsight's 20/20, right? As things decrease, I should have done this, should have done that. I should have gotten a fixed. It's it's increasing like crazy now, the rates. But it just depends on what your circumstances are, right? Like if you could stomach, I mean, no one could really stomach it, right? If it goes up, the costs go too high, maybe it's time for you to lock it in if it was a variable at that time, right? So it's a conversation to be had in the household. It's not something we could determine for you, right? But if it keeps going down and you had a fixed, well, sorry, that's something that we should have, I don't think that you should have addressed ahead of time, but something that we need to accept. Like, is that something you're okay with if it keeps going down, but you have a fixed? I have a fixed mortgage, actually, that I refied, and I was happy with the 4.14, knowing that potentially the one that I had before was a variable. I was happy just going with the fixed at 4.14. Why? because I have tenants in there, and I also want that kind of the certainty, right? I don't want like things to change too much drastically. I already kept it on a variable because I knew I was going to refi and break the mortgage at some point. But then now that the unit's stabilized, I don't want to actually think about too many other things rather than just focusing on maybe helping my tenant whenever there's issues when it comes to maintenance, as opposed to fixed variable, that feeling, what buyer's remorse after the fact. I didn't want to deal with that stress. So I was just like, okay. But it's a conversation to be had in your household, though.
Well, greatly appreciate that. So again, fixed or variable sort of depends, of course, on the circumstance. So we're going to quickly sort of just follow up. I guess some of the main questions are, what are some of the costs that maybe people don't expect when they get into that first home?
So when we buy our first home, most of the time, as the name in a first-time home buyer entails, first time. So there's a lot of things that no one ever expects, like maintenance issues, right? Depending on the age of your home, you're gonna have issues when it comes to the plumbing, maintenance, roof, all these things. So it's good to know, depending on how old your home is, to have emergency fund or extra reserves to fix and remediate these issues, right? Because you gotta know too, you can't leave leaks unattended. Water is the enemy, right? Your foundation cracks, you gotta fix that right away. There's a roof leak, you gotta fix it right away. Otherwise, there's mold. It becomes like a nightmare for people living in it and also remediating it after. But we also gotta talk about pre-buying, right? So there's some things to think about, like lawyer fees, land transfer tax, right? Land transfer gets subsidized partially as a first-time home buyer, depending on the size of the price of the property. And then there's also like different appraisals you have to pay for. If there is a fee with your mortgage broker, there's a whole bunch of other costs, administrative costs as well. Your lawyer fee could range. It could be up to like $2,000. Depending on your lawyer, I've seen a little bit more expensive than that, a little bit less. But for the most part, they say 1% to 4.5% closing of your mortgage or the price of the property. I think it's the price of the property, not the loan amount. That should be like a good safe buffer. I know 4.5 is on the higher end side, but if you can, that would be like, if you don't have to spend it all, it's okay too, right? It's more money. It's money that you put back into your pocket, but just have it prepared ahead of time because you might never know. There's just a lot of different costs associated, and doing a lot of closings over the years, I've seen like a lot of things too. Like sometimes you get lucky and you can negotiate like prices down a little bit, but in a hotter market, you can't, you have to go, even if you get like an inspector, for example, like it doesn't really matter. You have to go all conditions waived. So that's something that inspector you'll get after the fact, right? But in a market like we have today, maybe you can get more, you can get more. You could probably go in with an inspector. You can put in, some conditions. But in a market where it's too hot, you hire the inspector afterwards. But that's also an additional cost as well. On top of that, the things that you were not able to, foresee on the inspection, you got to start fixing those things now.
Of course.
So it's tough. It's a lot of extra costs. So just keep that in mind, 1 to 4.5%.
Perfect. Well, thank you very much for your time, Kevin. We do appreciate you taking your time out to talk to us. This is Kevin from APS, the APS team. We do appreciate that. And again, this does obviously reinforce the idea of that emergency fund and keeping a backup of liquid cash available. Thank you so much for joining us. We do look forward to having you back Tuesday the 31st for that webinar. We do hope all of you at home can join us on the Tuesday the 31st of March from 6:30 to 7. Again, from the TFT team, from Dollars to Dreams, thanks for joining us.